The Dow Jones Industrial Average dropped 427 points today.
Wow.
Yeah, that's a 0.9% decline, and it just abruptly snapped that winning streak we had from last week's rally.
December did not start quietly.
Yeah.
I mean, after a fantastic November, this felt like a very sudden reminder that risk is still out there.
It really did. The S&P 500 fell about 0.5%, the Nasdaq was down 0.38%, and it just felt like liquidity vanished right at the open. So the big question is, why today? What was the one trigger that caused this big risk-off move?
I think if you trace it back to the origin point, the dominant theme was absolutely a global carry trade unwinding
A carry trade in a way.
and a big risk recalibration. And for the first time in a while, the pressure came almost entirely from Tokyo, from the Bank of Japan.
Okay, let's unpack that, because the BOJ usually moves, at the speed of a glacier. What on earth did they do to spook the entire global market?
Well, the BOJ governor, Kazuo Ueda, he delivered what markets took as his clearest signal yet that a rate hike in December is now seriously on the table.
A December hike.
Yes. Potentially ending their whole negative interest rate policy era that has, it's defined Japan for years. This is a huge potential shift.
So how did the market react to that signal?
Immediately. The probability of a December move, it repriced from around 58% all the way up to 76%.
Wow, that's a jump of almost 20 percentage points. So traders took that very seriously. But for someone listening who isn't tracking Asian markets, why does a potential Japanese rate hike cause a sell-off in U.S. stocks, and especially in something like Bitcoin?
It all comes down to what's called a reverse carry dynamic. And this is really the key to understanding all of today's action.
Okay.
For the better part of a decade, the Japanese yen has basically been the world's cheapest ATM. You had hedge funds, speculators, investors borrowing yen at almost zero interest. That's the carry trade.
Right, borrowing cheap to invest in something with a higher return.
Exactly. They use that money to fund high-risk, high-return bets everywhere else. U.S. stocks, emerging markets, and of course crypto. So now, if the BOJ hikes, the cost of borrowing that yen suddenly goes up, your funding cost rises, and the whole trade becomes unprofitable. Or even worse, it becomes toxic.
So you're forced to sell.
You're forced to unwind. We saw Japanese 2-year yields surge today to their highest level since 2008. So you have to sell those global assets, convert them back to yen, and pay back that suddenly very expensive loan. We even saw the yen strengthen against the dollar by almost 0.5%, which confirms that repatriation is happening.
So that strengthening yen is the signal. It means people are selling Bitcoin, they're selling Nasdaq futures, all to get yen to cover their loans. It's pure forced liquidation pressure.
Exactly. It's not about fundamentals at that point. It's just about margin calls and currency math.
So where did that shockwave hit the hardest? I mean, if we're talking about highly leveraged speculative assets, I have to assume the crypto space took the biggest punch.
Oh, absolutely. The epicenter of the pain was definitely crypto. Bitcoin had its worst single-day drop since March.
Since March.
Yeah, it plunged roughly 6 to 7%. By the afternoon close, it was trading around $90,925, but it had touched some really nasty lows intraday, down around $86,000.
That is a huge drop for one day, especially after the run it's been on. What was the scale of that liquidation?
The data is pretty stark. We saw nearly $1 billion in leveraged crypto positions just wiped out. It was a cascade event.
$1 billion.
$1 billion. And when those margin calls all hit at once, it just creates an air pocket in prices. That's what happened today, a classic shakeout.
And we saw that immediately bleed into the public equities too, right? The crypto-related stock.
Yes, immediately. Companies like MicroStrategy, Coinbase, Riot platforms, they all fell hard.
Yeah.
Somewhere in that 3 to 7% range. And that actually created a measurable drag on the broader indexes.
Right. And beyond just crypto, the whole mood shifted. Let's talk about the fear gauge, the VIX. What did that tell us about market anxiety?
The VIX surged. It was up over 10.5% today, closing at 18.08. That's its largest single-day percentage gain in weeks.
So the quiet times are over.
Well, what's fascinating is that the volatility compression, that, quiet, predictable trading we saw over Thanksgiving, that has definitively reversed. It's a clear signal that people are waking up to the uncertainty in December and are starting to hedge aggressively.
Okay, so this is where it gets really interesting for me. We have this clear BOJ-driven risk-off story. Crypto collapses, VIX spikes, equities are selling off, all signs of panic.
Right.
But the bond market and commodities showed some bizarre divergences that completely complicate that narrative. Let's start with treasuries. Why on earth did yields go up?
This is the key contradiction of the day. The 10-year Treasury yield jumped a significant 8 basis points to 4.1%,
So bonds were selling off.
a sharp sell-off. But at the same time, interest rate futures held steady, pricing in an 87 to 88% chance of a Fed rate cut in December.
That makes no sense. If the market's panicking, money should flow into treasuries, pushing yields down. And if the Fed is about to cut, yields should be falling, not rising. So what's the thinking here?
The interpretation is pretty sophisticated. Analysts are suggesting the yield increase isn't being driven by inflation fear or a sudden recession crisis.
Okay.
Instead, it suggests the market is pricing in improved growth prospects. They're betting on a soft landing, where the economy stays strong even as the Fed starts to ease a bit.
So it's a bear steepening.
It is. It's a classic bear steepening, where long-term yields rise faster than short-term ones.
So just to simplify that, bond prices are falling, yields are rising, not because the Fed is getting more aggressive, but because the market thinks the economy will be strong enough to warrant higher long-term rates. It's a growth optimistic sell-off.
Precisely, which is a very rare thing to see on a day of global liquidation. It creates this incredible tension in the market.
And that tension extends to commodities, right? On a classic risk-off day, when the ultimate risk asset, crypto, is collapsing, what did gold and silver do?
They completely defied the sell-off. We saw a really strong rotation into hard assets.
Rotations.
Silver was the standout performer of the day. It surged 3.83% to close at $58.57 an ounce.
Wow.
And it's just on this remarkable run. It's up over 91% year over year. Gold also did well, adding about 0.5%, trading near $4,242 an ounce.
So that's a clear sign that capital wasn't just fleeing risk, it was actively moving into other assets.
It was. It was a very clear rotation from digital stores of value to physical ones. And they got a little extra help from the dollar index, the DXY, which fell about 0.25%. A weaker dollar is usually a tailwind for metals.
So that breakdown, gold and silver up, Bitcoin down 6 or 7%, that's one of the big stories of the day.
It's one of the most notable features of the entire session.
Okay, so let's put it all back together in the stock market. The S&P 500 fell 0.5% to 6,812. Given the BOJ shock, the crypto collapse, the VIX spike, is this the start of a bigger correction or just some healthy consolidation?
I'd argue it looks much more like consolidation. I mean, that 0.5% dip, it barely made a dent in the 3.7% gain we saw just last week.
Good point.
And, crucially, the S&P held above that critical 6,800 psychological level. The fact that the decline wasn't much deeper, given the shock, it suggests there's still pretty high demand for equities underneath the surface.
And we saw some pockets of strength, right? Some sectors actually managed to swim against that tide.
We did. Two main ones. Energy led the gainers, up about 0.65%, helped by a little rally in crude oil. And consumer discretionary also managed a small gain.
On Cyber Monday optimism.
I think so, yeah. We're getting robust reports from the holiday weekend. Amazon was up 1.8%. Apple rose over 1.5% to a record close. We even saw strength in a name like Nvidia, up over 1%.
So growth and consumer themes are still alive. But where were the weakest spots, outside of the obvious crypto-related names?
Industrials led the losses. That's a sector that's been struggling a bit lately, down about 1.6% over the last month with all this tariff uncertainty. Financials also pulled back as investors tried to sort out these mixed signals on rates.
Right. And speaking of industrial struggles, we did get some weak economic data today on that front, the ISM manufacturing PMI.
We did. And this really complicates the macro picture. The PMI fell to 48.2, which was below what everyone was expecting.
And what does that number mean in context?
Well, it marks the 9th consecutive month of contraction for the U.S. manufacturing sector. 9 months. That's a very long stretch. And inside the report, new orders fell even further to 47.4.
So what's the major takeaway from almost a year of manufacturing weakness?
It just highlights the paradox of this economy. On one hand, the bond market is pricing in robust growth with that bear steepening. On the other, the physical industrial economy is clearly struggling.
Right.
And that weakness does support the case for the Fed to ease, but it also raises the question of whether rate cuts can even fix these problems, supply chain issues, soft global demand. The data suggests there are bigger issues at play than just the cost of capital.
Okay, so looking ahead, we've got this tension, BOJ liquidation versus U.S. growth optimism. What are the key technical levels and the upcoming events that you're watching to see if this consolidation holds?
Well, for the S&P 500, holding that 6,800 level is critical. If that breaks, we could see a deeper test. For Bitcoin, which got hit the hardest, that $88,000 to $90,000 zone is now critical support. A break below that could see it accelerate down towards 80,000.
And the economic calendar is just absolutely loaded this week, isn't it? And it all feeds right into that December FOMC meeting.
It's the most critical week for data before the Fed meets. We have the JOLTS job openings report tomorrow, then ISM services on Wednesday, which has been much stronger than manufacturing, and then the big one,
Non-farm payrolls on Friday.
the last major employment report the Fed will see. A hot number there could completely change the narrative around rate cuts.
It really could. So what's the one key unanswered question you're thinking about heading into this week?
For me, it comes back to the bond market. Will Treasury yields stabilize here around 4.1%, or will they keep pushing higher? Because if yields keep rising, those near certain rate cut odds might start to fade, and that would create a whole new level of volatility.
That BOJ-driven liquidation and the weird divergence between yields and commodities on one side and crypto on the other, it's definitely the most complex market dynamic we've seen in weeks.
I agree. The volatility compression is over. The market is repricing global risk.
All right, I think that covers today's complex action pretty well. That was, we called this type of session the daily consolidation.
Yeah, that's a good name for it. And if you found this breakdown helpful, please do take a moment to like and subscribe.
And as always, remember, this is all for informational and educational purposes. It should not be taken as financial or investment advice. Always do your own research.
That's right.
We're back every trading day after the close to break it all down for you.
See you tomorrow.